Hey, what's up everyone, and welcome to the School of Personal Finance. So it's been a while since I put out my last video, and a lot has changed since the last video. I recently launched my own investment advisory firm called the School of Personal Finance. So I'm going to put out a video with more about that in the next couple of days or so. In this video, what I wanted to talk about was some smart things that you could do with your personal finances and your investments during this crazy time that we are living in. Let's get to it. So before I get into it, I just wanted to wish you and your family well through this crazy time. Hopefully everybody is healthy and not going completely insane being on lockdown. I mean, we're hanging in, but as most of you know, I have 3 little kids. Between homeschooling and me and my wife both running businesses out of the house, it's hard. You know, it's just, it's crazy. And I picked a great time to actually start helping clients again and taking individual clients and managing money again. It's been a crazy past few months. So hopefully there's a light at the end of this tunnel, but we shall see. So, you know, when I was thinking about doing this video, there's really 2 camps that people fall into. There are people who are in survival mode and people who are in opportunity mode. And it's 2 very different frames of mind depending on which mode you're in. So I'm going to kind of cover, you know, both of those, and they do intertwine a little bit. So the first thing that I recommend everybody does during this time, and it's a smart thing to do, and I recommend it, you know, when I'm doing a financial plan for somebody or I'm meeting with somebody, it's always the first thing I recommend. Pandemic or not, it's always the first thing I recommend. And that's getting a hold, taking inventory of where you stand financially. So that's doing like a net worth statement, a cash flow statement. I've done a few videos on those in the past where I walk you through exactly how to do that. Because you have to know where your money's at. You have to know how much it costs for you to live every month, to survive. You have to know what types of accounts you have, how much money you have in the bank right now. This stuff is important right now, especially if you're in survival mode. So if you're in survival mode, a few very good tips for you is to plan out each month. Act as if you're going month to month and you're just trying to get by until you get through this. Like if you're collecting unemployment right now, if you lost your job, you have to have some kind of action plan for the next few months to get through this pandemic. So that might be if you list out your assets and you realize that, you know what, I have this amount of money in my IRA, I have this amount of money in my 401k. With the recent passage of the CARES Act, there are ways that you could access that money this year if you've been impacted by the coronavirus. So you want to learn more about the CARES Act and how it might benefit you if you really find yourself in dire straits, in an emergency situation where you got to figure out where your money's coming from in order to get by month to month. So survival mode, first thing you need to do, take inventory, see where your money's at, what kind of accounts you have, where could you pull from in case of an emergency. Another thing that you want to do is look at your available lines of credit. So not like I recommend using credit cards, but you know, desperate times call for desperate measures. So you want to see how big of credit lines you have available. What kind of cash advance access do you have on that? If God forbid, you have to take a cash advance on a credit card, which you should never do. But if you do need to use credit cards to get through these next couple of months, you want to know how much you have, and you kind of want to have everything in a pecking order so you know exactly how many months you could kind of survive going through this before you really have to start pulling money out of retirement accounts or, you know, taking desperate measures to kind of get through. So that's my first tip. Get your financials in order. And now this second tip is for people who are more in opportunity mode. If you still have your job, if you're still contributing to your 401k, this is a great time to try to juice up your contributions. Try to make it hurt a little bit. Try to put as much money as you can into your 401k while the stock market is down. Now, at the time that I'm making this video, the stock market's actually bounced back a lot. And who knows if it's going to continue on that path or if we're going to have another downturn. There's so much uncertainty right now. But as we get pullbacks in the market, it's always a great time to put more into your 401k and take advantage of dollar cost averaging and try to throw in bigger chunks as we have downturns in the market. You should be able to do this just through a simple form with your payroll or your HR department to juice up the contributions, and then you could bring them back down later on. But it's a great time to do that. And now my third tip is something that we call tax loss harvesting. This really only applies to like taxable brokerage accounts. So non-retirement money. So if you have money in the brokerage account and you have different mutual funds or stocks, it's a good time to go through and look to see if you have any losers in there that maybe you could sell, that you don't see value in owning them anymore. So just a quick example, like if you have an oil company in there or an airline company that's just gotten demolished through this, if you sell it now, odds are you have a loss in that stock or in a fund. If you sell it at a loss, you could then take that loss and offset any gains that you might have in the year for any stocks you sell that have a gain. Or you could take a deduction on your tax return for up to $3,000 of that loss and then carry the rest going forward. So this is a good time to tax loss harvest. And that just means selling some losers, realizing the tax loss, and being able to use that to your advantage by either offsetting gains or taking a deduction now and then carrying the rest forward for future years when you might have capital gains. And then my fourth idea would be to look at your specific situation and see if it makes sense for you to convert some of your traditional IRA or 401k money over to a Roth IRA or Roth 401k. And the reason that you would do this is if you have a lower income this year, it might make sense for you to take some of your traditional IRA money that you haven't paid tax on yet, and convert it. So when you do that, you pay the taxes now, and then you never pay tax on it again. So for example, if you have $100,000 in a traditional IRA, maybe you take $30,000 of it and you convert it. So you would have to pay tax on $30,000 as if it were income. It goes into your Roth IRA, and then it will grow from there tax-free, and it'll be tax-free forever as long as you follow the Roth IRA rules. It's a good idea to convert in years when you have lower income, when you're in a lower tax bracket. You might benefit from that later on down the road when you start to take money out of the Roth. And the Roth has many different advantages. I've made a video in the past about all the reasons that I love my Roth IRA. You should go check it out. I'm a big fan of the Roth. And for some people, this year might be a good time to do some conversions, to start moving some of that money from the taxable bucket in retirement to the tax-free bucket in retirement. But again, everybody's situation is so specific that you have to see if it works for you. You have to consult your financial advisor, you have to consult your CPA, see if it makes sense for you to do it in 2020. And then my last tip is to rebalance your portfolio. And I'm gonna actually show you an example, step by step, exactly how to go about doing that. And the reason that people rebalance is because your percentages, they get out of whack when the market drops a lot. So let's go to the example and I'll show you what I'm talking about. All right, so let's say that you have $300,000 in a retirement account and that your allocation is 70% stocks and 30% bonds. So that would mean that you have $210,000 in stocks or stock mutual funds or ETFs, and you have $90,000 in bond mutual funds or bond ETFs. Stocks are more aggressive, bonds is the more conservative piece. And now let's say that the market goes down 20%. So that would mean that you lost 20% of your $210,000 in stocks. That would be $42,000. So your stock piece would now be worth $168,000. And for the bond piece, typically in down markets, bonds hold up pretty well. Sometimes they will go up in value. So let's say that your $90,000 in bond funds goes up to $92,000. So now your overall portfolio has gone from $300,000 down to $260,000, right? So you lost 40 grand in this downturn in the market, this 20% downturn in the stock market, all right? And it's pretty painful and it sucks, and you're down 40 grand. So your allocation has now been thrown out of whack because it's only worth 260 now. You now have $168,000 in stocks. That's only 65% of your portfolio. And your bond piece has gone up a little bit. So now it's 35% of your total portfolio. And what rebalancing does, it takes that 65-35, which is out of whack, and it brings it back to your correct asset allocation, which is 70-30. So you're gonna bring that stock piece up by 5%, you're gonna bring the bond piece down by 5%. And the way to calculate it is very easy. You just take 70% of $260,000 to figure out exactly how much you should have in the stock market to get your allocation back in line. So in this case, it would be $182,000 that you should have in stocks, and your bond piece should go down from $92,000 to $78,000. So all you would do is you would sell $14,000 out of your bond funds, and you would go ahead and add that $14,000 into your stock funds, and this would bring you back to a 70-30 allocation. And the great thing about this is that it forces you to do things that you might not typically do. Because when the market is down 20%, it feels like crap. You feel like, I'm just losing money. I want to get out of the stock market. But what it does is it forces you to buy. It forces you to actually do the opposite of what your instincts are telling you, which your instincts are usually wrong. So it's a good thing, rebalancing. So by adding 14,000 when the market's down, you're buying lower, right? It's a good thing to do that. So by setting it up automatically, it takes the thinking out of it. A lot of people, they'll set up their accounts to rebalance once a year, rebalance every 6 months, but typically the market doesn't drop this much. So there isn't this much out of whackness in the accounts causing the rebalance, to this magnitude. But when the markets are down 30%, 40%, it's a great time to rebalance because it forces you to go in and buy when prices are lower. And just to continue on that point a little bit, it's usually when the markets feel the worst, like the end of March, when it just felt like the world was coming to an end and the market was going down each and every day, and you're like, oh my gosh, I'm going to lose all of my money. That is usually the time that people panic and want to sell out. But when you look back on it, it usually ends up being a great time to actually put some money into it. So on the days when you feel the worst, if you have any money laying around, it's usually a good idea to throw a little bit at the stock market and see where we go from there. Not all of it. Don't commit everything in one, fell swoop, but it's a good idea to just kind of piece your way into the market on days that feel terrible. And the opposite's also true. As the stock market's running and it feels like it's going up every single day and you're missing out and oh man, the market keeps going up and I'm missing this huge run, that's usually the wrong time to start throwing money back into the market. You usually want to do the opposite of that. But it's so psychological. And the truth is, in the short term, nobody knows where the market's going. Anybody who tells you that they know that you missed the run and that the market, is going to rebound from here, it's going to go down from here, people do not know. There is no way of knowing over the short term. It is a gamble. That's why you have to have a plan, stick to it. Great advice is to pick levels. If the market gets to a certain level, commit before it gets there. If the S&P gets back down to 2350, I'm going to buy some. Or if the S&P runs another 30% from here, I'm going to take a little bit off the table and get back to a little bit more conservative allocation. But it's just impossible over the short term. It's gambling. That's why, especially financial advisors, financial professionals, they always talk about a long-term time horizon because we have history on our side when we look at it that way. I feel pretty comfortable saying to you that the market's going to be higher 10 years from now. Even 5 years from now, I think the market's going to be higher than it is now. 5 weeks from now, 5 months from now, 10 months from now, I have no idea. Nobody knows. Anybody who tells you they have a 50-50 shot of being right, so they figure they'll throw it out there. But the truth is, it's just impossible to know. And especially when you're looking even shorter term. Like, yeah, you could try to play momentum, like the market's run 5 days in a row. I think we're going to have a down day or 2 down days in a row. You could try to play that game, but nobody knows. That's why as far as investing goes, long-term time horizon, it's just the best way, the safest way to play it. And you want to have your asset allocation something that you're comfortable with. Through this downturn in the market, there was a gut check for a lot of people, especially people who are close to retirement and they found themselves being allocated too heavy in stocks. Like, yeah, the market's had a great run leading up to this pandemic, so people might have felt comfortable being overly aggressive in the stock market. But this was a real reality check, and it tests your asset allocation and how you handle risk. So remember that as you get older, the markets aren't always rosy and you're going to have downturns, and you have to be able to live with it and be comfortable losing a percentage of your portfolio. And as long as you have it for the long term, it should eventually bounce back. But nobody knows, it's all uncertain. So obviously everything I've said today, it's not specific to you. I don't know your individual situation. I can't give you personal advice through a YouTube video. It's really for entertainment and educational purposes. If you'd like me to give you specific advice, reach out to me. Head over to schoolofpersonalfinance.com. Check out in the different ways that you could work with me. You could schedule a call with me. Please make sure to subscribe to this channel. I'm going to try to get back onto a routine. I really enjoy making these videos. I've missed doing it the last few months. I'm going to try to get back on the routine of making these videos at least once a week or so. We'll see how this goes. It's kind of crazy around here with my 3 children and everything that's going on. But I do really enjoy making them and putting them out there. So I will see you again in the next one. Thanks for sticking around. Talk to you soon.